Welcome back everyone to the Audacious Witch channel where we talk about the magic behind the stock market. Target just announced something so unthinkable your world's about to flip. In just days, something terrifying is coming towards us. Worse than that, because it's not just Target. As you're about to see, it's every major retailer. We are going to step into Foot Locker, Nike, Victoria's Secret, and Lululemon. The economic impact, it's going to be a complete nightmare. Stick with me because this is unfolding right now, and what's coming will leave you completely speechless. As Target announces the unthinkable.
Have you ever heard of Target before? Well, if you have, it is a company I do own. Target is a position I'm building. I want to continue to build this. Do I want to buy more Target shares? Answer to that is absolutely yes.
Like, Target's one of the most comfortable stocks I would possibly feel like holding for the next 5 years in the market. Like, literally, if you told me I had to put all my money in one stock for the next 5 years, Target would be up there. I don't know if it would be the stock, like, let's say I wasn't allowed to trade at all. I mean, if I just had to put all my money in one stock, I might feel pretty dang comfortable in Target, to be honest.
As they and Foot Locker warn us consumers of higher prices from tariffs. This is coming very soon to stores near you from companies all over the world. You're going to watch them raise their prices and say, look, we have no choice. Prices are going up due to the tariffs. But the reality is the inventory on their shelves is not affected by the tariffs. But they're going to use that as an excuse to raise their prices.
Like fruits and vegetables, where during this winter season, we depend on Mexico for a significant amount of supply. Those are categories where we'll try to protect pricing, but the consumer will likely see price increases over the next couple of days.
Over the next couple of days, so those go
are
in
really
instantaneously?
Short supply chains. You think about all the fresh produce. We're going to try to make sure we can do everything we can to protect pricing, but if there's a 25% tariff, those prices will go up.
For things like what? Strawberries, avocados, bananas? What are we talking about?
You've got that list right.
Is that so?
Those are some of the key items.
And those prices could change within days in the stores?
Could change certainly over the next week.
And that's going to have a major impact across the country to every household, whether you shop at Target or not, because you're going to see retailers raising their prices across the board. And one of the issues we're facing is the U.S. economy is slowing. We're already seeing income growth slow down and hours worked are getting cut. This is making it even worse for households that are struggling to keep up with inflation. What this is indicating is the demand is going to plunge in a major way. Shares in Target plunging.
In light of ongoing consumer uncertainty and a small decline in February net sales, combined with tariff uncertainty and the expected timing of certain costs within the fiscal year, the company expects to see meaningful year-over-year profit pressure in the first quarter relative to the remainder of the year.
The stock was down 20% over the past 12 months. Keep in mind, they're going to be lucky to see little or no sales growth this year. If demand continues to fall, they're going to see negative growth. We're going to see that across retailers all over the country. And the issue is when demand goes down, well, there's another part of the demand equation that falls, and that's the labor market. It's killing demand fast. Have you been wondering why the unemployment rate kept steady at 4% and not going up? Well, it's about to go up faster after this. Because we have T-Man's efforts to pare down the federal government workforce left a mark on the labor market. With announced job cuts at their highest level in nearly 5 years, U.S. employers announced 172,017 layoffs for the month, up 245% from January and the highest monthly count since July 2020, during the heightened uncertainty from the pandemic. In addition, it marked the highest total for the month of February since 2009 during the global financial crisis. More than 1/3 of the total came from Tesla CEO Elon's efforts, with T-Man's blessing to reduce the federal headcount. Payrolls processing firm ADP reported Wednesday that private sector hiring grew by just 77,000 in February. As U.S. firms had 77,000 jobs, the smallest gain since July, this according to ADP, and this is a major problem for the U.S. economy because we're seeing a deceleration and jobs created. Now I want you to think back to what happened after the election. Businesses were very optimistic. They said the U.S. economy was going to boom. And it was going to boom on the back of strong consumer spending. And that didn't happen. And now there's a major problem because the labor market is starting to unwind. When you see periods of rising inflation slowing payroll growth, we suggest we're headed right into a recession. As you're about to see, and Wednesday's figures add another recent data pointing to a slowdown in the labor market. As applications for unemployment benefits in the most recent period reach the highest level this year, amid a growing number of job cuts at companies including federal contractors, and this is something that can be rather confusing. Because you see these headlines, payroll reports, and what do they tell you? That there's jobs being created at the same time the number of unemployment claims is rising. And this is something we see throughout history in terms of market cycles. You see these decelerations and payroll growth against rising claims, and what it tells you again, we're headed right into a recession. Let's look at some historical data we've got. The real issue is, you're seeing right here, is that hours worked decline going right into 91 recession. That led to people losing their jobs. You see it happen again going to the dot-com bubble. It's hours worked to an inflection point. They came down, employers laid off. You see it happen going the global financial crisis. And you can very clearly see what's happening right now. Hours worked are plunging, and what that's telling us is that continued claims are headed higher, according to the Challenger report. It's not just government cutting back. Retail saw 38,956 cuts for the month as companies such as Macy's and Forever 21 announced sharp staff reductions. The sector's cuts in 2025 are up nearly sixfold from where they were in 2024. Tech firms also listed another 14,000 in reductions. Initial unemployment claims have perked up in recent weeks, particularly in Washington, D.C., with its large share of government workers. 500,000 jobs on the line as Doge fallout spreads. As forecasters believe it could get much worse if these numbers on federal workers turn out to be accurate. And if you include the grantees and contracts, these numbers are going to be significant, and that's going to have a huge impact on the U.S. economy. So economies are already slowing down, and then inflation is looking to head higher. The reaction by the government is to clean house. That's going to put a lot of people on unemployment. It's going to cause their spending to plunge. You can see that the actions that we're taking right now with the tariffs and everything else could plunge us right into a stagflation and a recession, alongside the rest of the world. Because what tariffs mean is higher consumer prices, as we're seeing a very clear slowdown in demand for labor, particularly as a government looks to lay off mass amounts of people. What the markets are saying very clearly is we see we're heading into stagflationary recession, and perhaps there's no way to turn back. If you want more evidence, Foot Locker just said it expects another year of deep discounts in the sneaker industry as its largest brand partner, Nike, continues its reset and relies on markdowns to clear through stale inventory. Foot Locker stock missed analyst revenue expectations, falling short on sales for fiscal 2025. Foot Locker is expecting profits to be lower than Wall Street estimated. Sales dropped to $2.25 billion, down nearly 6% from a year earlier, but inflation adjusted the sales volume. It's still nowhere near zero growth. People can't worry about how new shoes look on their feet when they're worried about gas prices and egg prices on an empty stomach. While Foot Locker improved profits compared with its prior quarter, it's not expecting that trend to continue in its current year, thanks to deep promotional activity across the sneaker marketplace. It's expecting adjusted EPS to be well behind Wall Street estimates as well. Foot Locker's expectations that promotional pressures will weigh on margins in the year ahead indicates that it's still having issues with Nike, its largest brand partner. New CEO Elliott Hill said it's relying on deep discounts to clear out inventory. I think consumer demand is very obvious, adding into Nike and Foot Locker's weakness by the day. Nike still represents about 60% of sales of Foot Locker. In December, Hill outlined his strategy to return Nike to growth and said deep discounting was blame for declining revenue and profit. As a Nike shareholder, let's just focus on the long term and collect those dividends. Why do I think this could be a long wait for Nike? Because the markets aren't just pricing in rising inflation, they're pricing in a weak labor market, and that's exactly what we're seeing in the US. Because what the markets are actually saying is, look, in the past, we saw a strong labor market, so if prices went up, we assumed that people could afford them. But now with the threat that inflation's going to go higher and job markets going to get weaker, this doesn't look good for Nike. Foot Locker is shrinking. It's expecting the number of stores to decline by 4% in 2025 and square footage to fall 2%. Foot Locker's biggest weak spot was its Asia Pacific region, where sales dropped 14.1% during the quarter. In August, Foot Locker said it was closing its stores around the world and e-commerce operations in South Korea, Denmark, Norway, and Sweden. Victoria's Secret CEO Hilary Super said holiday quarter sales were up for Victoria's Secret, Pink, and their beauty business. So why is the stock still tank 8%? The weak outlook as we begin the new year, we recognize the macro environment is uncertain and consumer confidence has shifted. Our forecast assumes that the environment will gradually get better. Clearly, the institution doesn't believe it's going to get better for the rest of the year. For Wall Street, it amounts to higher unemployment and lower consumer spending. There you can see why stocks are coming down, presenting additional downside risk for the US economy. So, the only takeaway stock you should consider in this video is Lululemon. The only company without tariffs risk. This management team's deep mind and vision just blew me away. Lululemon doesn't source anything from Canada, has limited production in Mexico and China. CFO Megan Frank told analysts in December about 3% of the company's goods are made in China, and less than 0.5% comes from Mexico. In 2023, 42% of its products were manufactured in Vietnam, 16% in Cambodia, 11% in Sri Lanka, 10% in Indonesia, 8% in Bangladesh, and remainder in other regions. According to stock filings, yes, I still own Lululemon.